Okay, so we're still doing this question on XYZ Limited. We have their financial statements here, income statement, and balance sheet. Okay, last time we looked at the profitability and liquidity ratios. So now we're going to look at the gearing and leverage ratios. Okay, so whenever you hear this word gearing, okay, it's just how much debt the company uses. Okay, remember, as you're investing in companies, right, it's important to know what type of funding your company is using mostly. Okay, there is equity funding. Equity funding, think of it as the owner's money. Okay, remember every shareholder is the owner of your company. Okay, so when they buy shares collectively, that becomes the ordinary share capital. That's the equity there, the owner's money. And there's also debt financing. Okay. So the more debt a company takes on, what risks come in, colleagues? Okay. If you're a company and you're taking on a lot of debt, what risk is going to are you going to incur? Yes, Madam Mary. If a company is taking on too much debt, what type of risk will be associated with that company? Madam Josephine, Madam Juliet, Mr. Kennedy. Okay, us as an individual, if you're taking on more debt, what risk are we associating ourselves with? Or what will happen basically? Maybe you're thinking that the risk has got a certain name. It's got a name, yes. It's got a certain name, but I'm asking it as a general question. Okay. If you as an individual are just getting loans here and there, what risk are you? Yes, Mr. Kennedy. Good evening, sir. Mhm. And what risk are we associating the company with if it's taking on a lot of debt? Or what can happen if a company is taking on too much debt? What's likely to happen? Yes. Hello. Mhm. Yes. The company can fail to pay back the debt. Okay, colleagues? The company can fail to pay back the debt, which is financial risk. Okay. When you hear financial risk, this is the risk attached where a company takes on too much debt, then it fails to pay back. Okay. And remember, if you can't pay your creditors, a lot of things can happen. They can come and collect what is theirs. Even when a company is being liquidated, the first people to be taken care of are the creditors, the people who gave the company loans. Okay. And the more the company takes on debt, okay, it also affects the dividends for the shareholders. Okay. Because as we can see here in the financial statement, okay, remember the dividends come from this net profit here. Okay. Now, earlier on, before you get your net profit, you have this interest expense. So if this interest expense increases, it's going to have a trickle down effect to also lower down this net profit. And the less net profit you have, sometimes even the shareholders might not be paid. So you as an investor, if you say a company is using more debt than equity, then there's attach a financial risk to that. Okay, it's not good for a company to be utilizing a lot of debt. All right, certain companies and certain industries, it's allowed, yes, for them to use more debt than equity. Okay, but for on average, most companies that we see, it is better at least if the company is using their own money, equity financing. Okay, it is better. Okay, yes. So we're going to look at the debt to equity ratio, right? Debt to equity ratio, okay, which is just the total liabilities over the total equity. Okay. If this debt to equity ratio is greater than one, then you've got more debt than equity. You're using more debt financing than equity. Okay. If this ratio is more than one, okay. Yes. So in our financial statements, you go to the total liabilities. Okay. You see current and non-current. Total liabilities 2 million. Okay. The total equity 1,600,000. Already from the financial statement, we can see that this company has got more debt than equity. All right. So we just divide the two. 2 million divided by 1,600,000, we get 1.25. Okay. So how you can interpret this? The company uses 1 kwacha 25 ngwe of debt for every 1 kwacha of its own money. Okay, you're just comparing the debt to the its own money. It uses, so here we can see it uses more debt than its own money. Okay, so this company XYZ has a financial risk attached to it because it's got a, a lot of debt. Okay, so if it doesn't make profits that year, it might even default on some of these interest payments or these debt payments. Right? Yes. So you can say this company is leveraged, meaning it relies more on lenders' money than its own funding. So it uses more debt than equity financing. Yes. Any questions? Mm-hmm. For now, I can only say the bank. I don't know the other about other companies. Okay. But like banks use mostly your money for their operations. So a bank, if you have to go on a bank's financial statement, you see a high debt to equity ratio on average. But these companies within the average companies, it's a different story, madam. Was there another question? Hmm. I said if this ratio is greater than one, it uses more debt than company uses more debt than equity. Then this 1.2, yes, then this 1.25, you're saying the company uses 1 kwacha 25 ngwe of debt financing for every 1 quarter of its own money. So it's like you're comparing here how much debt versus your own money. Okay. How much debt you're using versus your own money. Here's a comparison in this interpretation. I hope I've answered your question, sir. And is there any other questions? Okay. You have the interest coverage ratio, basically asking, can you cover your interest expenses with your operating profit? Okay. Or how many times can you cover your interest expense with your operating profit? Okay. EBIT is operating profit. In other books, you might see PBIT. It's just EBIT is earnings before interest and tax. Okay. PBIT is profit before interest and tax. Okay. Yes. So you go to your income statement here. You look at what is your interest expense, 150,000. What is your operating profit? 900,000. So you just say 900,000 divided by 150,000 equals 6. So basically, you can pay off your interest expense 6 times with your operating profit. Okay, which is a good sign. Okay, it's a good sign. Okay, it means this company is not going to default. Okay, because its operating profit can cover its interest expense. Okay. The only time you need to worry is if you get a decimal point. It means you cannot cover your interest expense with your operating profit, which is a very, very bad signal or a bad sign. Okay. If a company is interest coverage ratio is less than 1, it's a bad thing because it means you cannot cover your interest expense with your operating profit. Okay. So you can see I'm using the same logic as if remember when we looked at the current ratio. Okay, remember in the current ratio we said how many times we can use our current assets to cover our current liabilities. Okay, and we saw anytime it's greater than 1, it means that's a good sign. You can cover your current assets with your current liability. I mean, you can cover your current liabilities with your current assets. Similar with this one here. You can cover your interest expense 6 times. You can pay off your interest 6 times with your operating profit. Okay, so this is very good for a company. Okay, despite it having a high debt to equity ratio, okay, unless it can cover its interest expense. Yes. Any questions before we go to the debt to capital ratio? Okay, so the debt to capital ratio basically just saying out of your total source of financing, what share goes to debt basically. Okay. Remember this, have you seen this formula here? Total equity plus long-term debt. This is what you call capital employed. Okay. Capital employed. Right. Capital employed, this is the money that is used by a business to invest and expand its operations so that it can make more profits. Okay, that's what capital employed is. Money that is taken by the business and it is invested Maybe invested in new factories, new equipment, new technology, so that it can help the businesses operations so that they can make profits in the future. Okay. So, like capital employed, this is like your long-term source of financing. Okay, long-term source of financing. So, capital employed involves equity and long-term debt. So now I want to find out of this total long-term source of financing, what proportion goes to debt, what proportion goes to equity. Okay. So here it's your long-term debt. Okay. Here you're not focusing on the short-term debt where we included current assets. No, we're only focusing on long-term debt. Okay, which is your non-current liabilities. Okay, we're not focusing on the current liabilities, only focusing on the non-current liabilities. Okay, yes. So the long-term debt, which is your non-current liabilities, is 1,200,000. Your capital employed, which involves your equity, the money raised from equity and the money raised from the debt financing, that's 2.8 million. So you're going to say out of this 2.8 million, what percentage is debt? What percentage represents debt? Okay, and you're going to get 42.86%. Okay. So debt, long-term debt represents 43% of your company's financing. Okay. The remainder, which is equity, represents 100 minus 43%. That's the remainder goes to equity financing. Yes. Any questions, colleagues? Okay. We can go to the investor ratios or the market ratios. We saw a lot of this in the assignment. Okay. Yes, these investor ratios. The first one we have earnings per share. And as I said last time, earnings per share. This is saying if the company pays out all of its net profit, how much will each shareholder get? Okay, as you can see here, net profit after tax divided by number of shares. Okay. If you look in the financial statement, number of shares 500,000, and then here our net profit after tax 525,000. Okay, so we're saying if all of these 525,000 was given out to all the shareholders, how much is each shareholder going to get? Or for owning each share, how much are you going to get? Okay, so the earnings per share, let's see where is that. So we're going to say our net profit after tax 525,000 divided by the number of shares 500,000. So when you divide this, you get $1.50 per share. Yeah. So if the company distributed all of its profit to the shareholders, each shareholder will get $1.05. Okay. Mhm. Any questions? Okay. Now, it's very rare to see a company pay off all of its net profit to the shareholders. It's very rare. Okay. Because it means all your profit has gone to the shareholders. You don't keep anything to the company. And as we know, that wouldn't be a very smart decision to do. Okay. So this one's more like on a theoretical basis because it's very rare for a company to distribute all of its net profit after tax. Okay. Any questions? Right. Dividend per share, basically how much each shareholder is getting. Okay. Just your dividends paid by the number of shares. Okay. So remember, in our income statement, they told us dividends paid was 210,000. Number of shares, 500,000 shares. So 210 divided by 500, you get, excuse me, 42 cents per share. Okay. So this is how much each shareholder got for that respective year. Okay. So for these ratios, the higher the better. Okay. The higher the better. Okay. Because, as I say, these are for the investors to see. Okay. So a company that has got a higher, especially dividend per share, because this is what is actually paid out, it's going to be a good thing. Okay. All right. Then you've also got the price to earnings ratio. How much investors are willing to pay for every one quarter or for every $1 of earnings for this company. Okay. The price to earnings ratio is the market price of the shares over the earnings per share. Okay. In the question, they told us the market price for this company told us it was 12 kwacha. Oh, $12. Okay. Our earnings per share, we tabulated it as $1, $1, I think, 5 cents. So 12 divided by 1.05, you get 11.43. So it's basically saying investors are willing to pay $11.43 for every $1 of earnings for this company. So this ratio, the higher the ratio, it just signals investor confidence. Because if people are willing to pay a higher amount for every $1 of earnings, then it means people are confident about this company. A lower ratio, lower investor confidence. Because if people are willing to pay less for every $1 of earnings, then really people are not, they don't have confidence in the company. Okay. Yes. Any questions? Okay. Um, then we've got these efficiency and return ratios. Okay. How efficient are you using capital, your equity, your assets, or is the capital that you've invested, the assets that you bought, are they bringing you any money? That's what these ratios are about. Okay. Yes. So we've got the first one here, return on capital employed. How much net profit you're getting from the money that you've invested in the company. Remember, capital employed, this is the money that is invested into the company for long-term purposes. Okay. So we are basically asking yourself, from this money that we've invested, this money we got from the shareholders and from our creditors, how much how much profit is it bringing us back? Okay. Yes. So you can say net profit after tax over capital employed times 100. Remember, capital employed, we said equity was 1.6 million, long-term debt 1.2, so you get 2.8 million. Our net profit was 525,000. Okay. So 525,000 divided by 2.8 million, you get 0.1875. Multiply by 100, 18.75%. Okay, which is just basically telling us if you invest $100, okay, let's say this $100 is your capital employed and you invest it, you're getting back $18.75 ngwe in a net profit from this $100 you invested. Okay. Other times, return on capital employed, you can also use your earnings before interest and tax or your operating profit. Okay. Same concept. From the money that you've invested for long-term purposes, which is your capital employed, how much operating profit are you getting back? That's what this ratio is saying. Okay. So instead of net profit on top here on the numerator, use earnings before interest and tax, which is your operating profit. Okay. Which was 900,000. Okay, so 900,000 divided by 2.8 million, 0.324, 3214 times 100, 32.14%, which is just telling us if you invested $100 as capital employed, invested this into your business, okay, you're getting back $32.14 as operating profit from this money you've invested. Okay, colleagues? So with these ratios, the higher the better. It's showing you that your capital employed is bringing you more profits. Okay. A higher return on capital employed is just telling you the money that you've invested is bringing you more profit. Okay. Which will signify efficient use of your resources. Okay. Yes. You also have return on assets. Basically, how much your assets are generating for you in terms of profit. Okay. These assets that you've got, how much they're generating for you in terms of profit. A higher ratio means your assets are generating you more profit. A lower ratio, your assets are generating you less profit, which means you're not efficiently using your assets. Okay. So even these return ratios can also be grouped under profitability because if your assets or your capital employed is bringing you more profit, then it means you're being profitable. So, okay. So these return ratios can be looked at in terms of efficiency. Are you utilizing your resources efficiently? When we say efficient, we mean you are not wasting these resources. Minimal waste of resources is what efficiency is. So here, return on assets, okay, net profit after tax. You can also use operating profit. Okay, you can also use operating profit, colleagues, over your total assets. Okay, so here our net profit was 525,000. Our total assets 3,600,000. When we divide this, you get 0.1458, which represents 14.58%. Okay, so in short, every one quarter that or every $100 you've put into your assets are bringing you back $14.58. Okay, if we use I prefer using the $100 figure. Okay. For every $100 of the assets that you own, you are getting $14.16 in terms of profit. Okay. So basically, we're just saying this is how much profit your assets are generating for you. Okay. Yes. Any questions? There's also, I think, did I, let me see. Yeah, return on equity before we go to net asset turnover. Okay. Return on equity, same concept. Now here, just focusing on the shareholders' money. Okay. The money that you've raised from selling shares, that money you've invested it. Now, how much profit is it bringing you back? That's what return on equity is saying. Okay. For every $100 or $1,000 of the shareholders' money that you've invested, how much net profit or operating profit are you getting back? Okay. So here, return on equity. Okay, 525,000 divided by total shareholders' equity, 1,600,000. Okay. Yes. Divide that and multiply by 100, that is 32.81%. Okay. So basically, for every $100 of the shareholders' money that you've invested, you're getting $32.81 as net profit. Okay. Yes. Any questions on that? Or look at net asset turnover. Okay, colleagues, this net assets is your total assets minus current liabilities. Okay, remember, net assets is also equal to capital employed. All right, colleagues, remember, net assets is also equal to capital employed. Let me just show you using the accounting equation so that you always remember this. Okay, remember the accounting equation. We said assets equals liabilities plus equity, right? Then remember, the liabilities break down into current liabilities plus non-current liabilities plus equity. Okay. So if we take the current liabilities over the equal sign, you have assets minus current liabilities equals non-current liabilities plus equity. Then on the left-hand side, this is what you get, net assets. On the right-hand side, you get capital employed. Okay, colleagues? Yes. So if in a equation, let's say they've told you net assets equals this amount, just know that's your capital employed. Okay. Yes. So the net asset turnover is just saying how much sales revenue are your net assets generating you for you. Okay. So net assets, total assets minus current liabilities, 2,800,000. Remember that was also our capital employed, 2,800,000. So the net asset turnover is just your revenue divided by the net assets. Okay. So 3,500,000, that's the sales revenue. Okay. This is the revenue that we generated divided by our net assets, 2,800,000. You get 1.25. So what this says, the company generates $1.25 in sales for every $1 of net assets owned. Okay. So the higher, the better. It means your assets are bringing you more sales. Okay. And the lower, it's not a good thing. Okay. A higher turnover is better. Yes. So colleagues, these are